My own suspicion is that the precious metals bull market that we're in now will be more profound than the bull market that we were in either the early 90s or in the decade 2000 to 2010. If I'm right, the consequence of that is that the move in silver, if it occurs, will be at least as dramatic as the markets that we've seen before, albeit from a higher base. But I'm tempted to say when leadership changes from gold to silver, the potential for dramatic moves in silver is much higher. It's important, again, to remember that when we talk about $50 being the nominal high for silver, we aren't talking about 2024 dollars. If we were talking about 2024, $2025, that number would be much, much, much higher.
As we approach the end of Q1, gold has already started 2025 by breaking records and stabilizing above the crucial $3,000 an ounce mark. Meanwhile, silver has been steadily gaining momentum. It is up 6.3% so far in March, following a 2.4% dip in February and a strong 10% rise in January, bringing its total gains for the year to approximately 13%. In a bull market, gains are rarely linear, and silver appears to be at the early stages of a significant upward trend. Despite being undervalued compared to gold, silver tends to surge rapidly once investor sentiment shifts. With its price still far from historical highs, the metal remains an essential yet often overlooked asset in the precious metals market. Rick Rule, president and CEO of Rule Investment Media, emphasizes that silver traditionally lags behind gold at the beginning of a bull market, but eventually outperforms due to its affordability and strong speculative appeal. Silver rose 21% in 2024, and its early 2025 performance suggests even greater potential. The metal is steadily approaching its all-time high of $50 an ounce, yet it remains an attractive opportunity at around $33 today. Unlike gold, primarily a monetary hedge, silver benefits from dual demand, serving as both a store of value and a critical industrial material. Its increasing use in electronics, renewable energy, and electric vehicle production supports long-term value growth, reinforcing its importance beyond traditional investment demand. Rick points to historical trends where silver has demonstrated the ability to deliver substantial gains when market conditions align. Looking at previous cycles, he notes how silver has experienced explosive rallies, such as its surge from around $4 to nearly $50 in past decades. With inflation rising, central banks maintaining accommodative policies, and investors seeking safe haven assets, silver appears poised for another explosive rally. Analysts at major financial institutions predict that silver could surge to $38 to $50 by year-end, with even greater upside potential in the coming years if macroeconomic trends favor precious metals. We present the clips of Rick's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
My experience is that when the momentum in precious metals returns and the generalist investors become attracted to the precious metals narrative, that leadership in the market changes from gold to silver. Precious metals markets are unique in that they're driven by both primary investment motivations, which is to say greed and fear. But fear predominates at the beginning of a precious metals bull market, which is why gold leads. We're seeing exactly that. We're seeing gold lead, and we're just beginning to see the gold narrative attract generalist investors. Once generalist investors come down into the precious metals space, perhaps because the lower unit value, lower unit price of silver begins to predominate. I don't know when that's going to occur. I don't even know why it's going to occur. But I do know that I have lived through three periods in my life where generalist investors have come into the precious metals narrative. And when that happens, leadership changes to silver. And by the way, Patrick, you won't need to ask Rick Rule. You'll see it in the market. When silver runs, it's a truly spectacular circumstance. Several times in my life, watched really epic runs in silver in the decade of the 1970s from $1.50 to 50. And by the way, that 50 is very different than today's 50. That happened in 1980. Remember what price levels were in 1980 until today. That number, if you were using real dollars, constant dollars, would be much, much, much higher. But then in the decade of the 70s, the silver price ran from something like $4 to 50 again. Crazy move, 12-fold move. And then in the decade 2000 to 2010, the silver price moved from $5 or $6 again to some number approaching 50, admittedly 50 nominal. My own suspicion is that the precious metals bull market that we're in now will be more profound than the bull market that we were in either the early 90s or in the decade 2000 to 2010. If I'm right, the consequence of that is that the move in silver, if it occurs, will be at least as dramatic as the markets that we've seen before, albeit from a higher base. You'll recall that the earlier runs took place in the context of a real price collapse. $50 back to $5, a 90% decrease in the nominal price of silver. We haven't seen that hard a pullback. We've seen a pullback from 50 down to, say, 20, now back up to 33. When leadership, and I'm tempted to say when, I should say if, but I'm tempted to say when, leadership changes from gold to silver, the potential for dramatic moves in silver is much higher. It's important, again, to remember that when we talk about $50 being the nominal high for silver, we aren't talking about 2024 dollars. If we were talking about 2024, $2025, that number would be much, much, much higher. And it wouldn't surprise me to see silver take out its real, not nominal, highs. Partially simply because when the generalist investor moves into precious metals, the space is so small that it can't accommodate the money. Patrick, you remember in earlier interviews, I pointed out that in the US market, the only one I really understand, the market share of precious metals and precious metals related securities is tiny. It represents less than 0.5%. Perhaps it does represent 0.5% of total savings and investment assets in the United States. The 4-decade mean is 2% market share. If demand for gold and silver merely reverted to the 4-decade mean, demand for the stuff grows fourfold. Understanding that prices aren't set across the whole transaction chain, but rather the delta between the supply and demand. If you quadruple demand for an asset class that is as small as precious metals, the price moves that you can get are truly astonishing. It doesn't happen often. It's happened 3 times in my life, but when it does, the results are mind-boggling.
Gold officially broke through the $3,000 mark for the first time in history, reaching $3,004.86 on March 14, 2025, before pulling back slightly. The speed of this rally has been unprecedented, with gold climbing from $2,500 to $3,000 in just 210 days, far faster than the historical average of nearly 5 years for similar price jumps. This rapid ascent reflects shifting market dynamics, with investors increasingly seeking stability amid economic uncertainty. An unprecedented wave of central bank purchases has largely driven the strong momentum in the gold market. Over the past year, central banks worldwide have steadily increased their gold reserves, seeking stability amid rising geopolitical tensions and concerns over the long-term viability of fiat currencies. Many emerging economies, in particular, have accelerated their gold acquisitions to reduce reliance on the US dollar in global trade. This persistent accumulation has provided a solid foundation for gold's rally, creating a supply-demand imbalance that pushes prices higher. With central banks signaling no slowdown in their buying spree, gold's upward trajectory appears far from over, reinforcing its role as a critical asset in the evolving financial landscape. Let's get back to the video.
I think the central bank buying is a function of the deteriorating strength of the US dollar. I think the immediate cause of the gold price increase is central bank buying, but I think it's important to understand why central banks are buying in favor of instruments that they had preferred over 40 years to gold. And that is, first of all, the weaponization of the US dollar. the realization by foreign central banks that the United States dollar isn't a neutral medium of exchange. The United States has politicized the dollar, which has in some senses forced foreign central banks to buy a medium of exchange that is also a better store of value. And the store of value is also, I think, problematic. When foreign central banks and large family offices, as an example, look at the encumbrances of the U.S. society, the $36 trillion in on-balance sheet debt and the $100 trillion in net present value of unfunded promises, Medicare, Medicaid, Social Security, and the foreign central banks juxtapose the yield on the U.S. 10-year Treasury with the deteriorating purchasing power of the U.S. dollar. In addition to the dollar being risky because of politics, it's also risky because of economics. So for those two reasons, we've seen really since 2022 concerted central bank buying of gold and disintermediation out of the U.S. Treasury, which has led to, I would argue, higher nominal, all-time high nominal gold prices. If you adjust the $3,000 gold price for the deteriorating purchasing power of the dollar, it's arguable that we aren't at all-time highs. It's arguable that we have further, perhaps substantially further, to rise. I believe that within 2 years, perhaps 5, but within 2 years, that there will be one or more broadly utilized gold tokens, gold trading on the distributed ledger that, well, when I say gold, a deposit receipt, redeemable and fully backed by gold. The World Gold Council is trying to affect this. The London bullion market is trying to affect this. I've made some investments. Sprott has made some investments. There are a variety of technologies around, first of all, establishing a deposit receipt that is recorded, entered, and transferred on the blockchain, and then tokenizing that. And I would expect that within 2, but certainly within 5, you will be able to have either a credit or a debit card in your wallet that allows you to save in gold, receive interest in gold, and transact in gold. This will likely be a private currency, like blockchain is, not government-sanctioned money. But I think it's all a good thing. I think the establishment of the psychological infrastructure around blockchain implemented transactions has allowed for gold to return to its former role. You can, in many countries, and I have, used gold as a medium of exchange. But the transaction costs are very, very, very high, among other reasons, because people need to assay the gold that they receive or pay. If you had London bullion market, World Gold Council certified storage facility where you knew that the gold in place was good delivery, good system delivery, and you knew that the token was fully backed by gold, you could lower your transaction costs substantially, just the same way that the hard transaction costs around cryptocurrencies are very, very low. I think that's just a really, really, really important development. And I think we're 2 to 5 years away from that. There will always be, and there is a place for, holders of physical gold and silver to have it outside of the blockchain, outside of the system. Because understand that the system is the system. This will be part of the global financial system. It will be within reach of governments. It will be within reach of institutional failure. So I'm not trying to suggest that blockchain-denominated delivery receipts will replace physical private ownership for gold or silver. I am merely suggesting that in addition to gold fulfilling that role, and in addition to gold fulfilling a role for central banks, that it will, in answer to your question, once again become a medium of exchange rather than merely a store of value.
Silver is poised to be one of the strongest performing assets in 2025, with market dynamics increasingly favoring its growth. Unlike gold, which primarily benefits from monetary and safe haven demand, silver has a unique dual role as an investment vehicle and a crucial industrial metal. The ongoing push for clean energy, including the expansion of solar panels, electric vehicles, and advanced battery technology, continues to drive industrial demand for silver at an accelerating pace. With the gold-silver ratio leaning in silver's favor, analysts anticipate it could significantly outpace gold's gains in the coming months. As more investors recognize silver's potential, its relatively lower price than gold makes it an attractive option for those seeking higher returns. If these trends hold, silver could yield 15 to 20% returns over the next year, cementing its status as a key asset in the evolving financial landscape. Share your thoughts on Rick's analysis in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.